Welcome everyone, and thank you for tuning in to hear my trading and market updates. This is Uncle Frank, and I'm not a financial advisor, nor is any of the content to be construed as financial advice. This channel is for entertainment purposes only. Please remember to hit the like button if you enjoyed the presentation, and be sure to subscribe to the channel so you're alerted when I have new information to share. So now let's get into the latest updates. Hey, welcome back everyone. We finally got some action. S&P 500 up 1.37%. The Dow up 1.4%. The Nasdaq up 1.38%. And the Russell 2000 up 3.52%. The Dow tops 37,000 for new record as stocks cheer Fed. Apple hits record high while big tech stocks rally. And why? Because the Fed holds rates at a 22-year high, signals 3 cuts in 2024. The Fed suggested it would ease policy next year while still leaving the door open for future rate hikes. Bloomberg's evening briefing said it best, so I'll share it with you. And the crowd went wild. As the U.S. Fed Reserve left interest rates the same on Wednesday, it also filled investors with joy by saying it foresees lowering rates by 75 basis points in 2024. Wall Street reacted with ecstasy as the Dow notched its first record close in almost 2 years, recouping all losses from Jay Powell's seemingly victorious war on inflation. Just 15 months ago, the Dow had slid into bear territory, but in recent months, the index has been buoyed by the prospect of a resilient U.S. economy, ebbing inflation, and strong corporate earnings. In November, the Dow rallied 8.8% to hit its biggest monthly gain in more than a year. Quote, "Beaten up stocks that are tied to the health of the economy have come back to life," said Eric Biley, Executive Managing Director of Wealth Management at Stewart Partners Global Advisory. Quote, "Stocks that have been hit by high rates are starting to recover." Subscribers to this show know that Uncle Frank hates Citigroup. They are AMC's chief investment banker. They are the author of the bullshit 8 preferred dividend, the reverse split, the conversion, all that garbage. They have a sell recommendation on our stock. They reiterate it constantly. They have a price target of $4.75 per share on us, and yes, they have been listed among our short sellers as well. So whenever they mess up, it brings joy to your host. Let's start back in March of 2020 with these headlines. Citigroup to close about 100 branches, cites declining foot traffic. And then from the BBC in 2021, Citigroup to exit consumer banking in 13 markets. Citigroup is closing its consumer banking operations in 13 markets across Asia, Europe, and the Middle East. And then, in July of this year, why Citibank branches are closing around the world. And then just a month ago, Chase and Citi customers say their accounts are being closed without warning. And then from Wednesday night in Bloomberg's evening briefing, Citigroup is offering a portion of annual bonuses early to those staffers who agree to depart. Under CEO Jane Fraser, the bank has engaged in a massive restructuring that includes an as yet untold number of firings. For some elite traders and bankers, their annual bonuses, usually paid in February, can stretch into millions of dollars. I personally hope they leave the bank and head directly to the SEC and sign up for the whistleblower program and get a nice fat check for the holidays. And speaking of bonuses, wait till you see the ones the AMC executives plan to pay themselves for 2023. You're going to be glad we raised money by selling our stock under 75 cents on a pre-split basis, because we're going to need it. Okay, and now an article from the shittiest outlet in modern history, Investor Place. Meme stocks alert. Hedge funds are suing the SEC over short selling rules. Hedge funds are questioning 2 new short selling rules. 3 hedge fund groups have sued the SEC over the new rules. They believe the rules contradict each other and harm market efficiency. The groups filed the lawsuit in the Fifth U.S. Circuit Court of Appeals. Okay, the first rule states that securities lenders must report each loan individually to the Financial Industry Regulatory Authority, that's FINRA. Meanwhile, the second rule states that some institutional investors must disclose and report short-selling information that will then be publicized on an aggregate basis 14 days after the end of the month. Okay. The practice of short selling received mainstream attention following the massive rise in GameStop in early 2021. During that time, short interest of GME peaked at 140%, leading retail investors to question whether naked short selling was at play. This event led to an increased interest in meme stocks, or stocks that have gained a cult following on social media. So Uncle Frank, please translate. Okay, nothing is going to happen, guys. The good news I'm hearing is if something systemic goes wrong, the hedgies are going to be blamed, which is music to my ears. As usual, the SEC doesn't give a rat's ass about what the hedgies do to us. This is really about the basis trade, protecting the treasury market and politicians from systemic risk brought by the hedgies and the bad headlines before an election year. Listen, hedgies don't follow rules and regulators don't enforce them anyway, so more new ones aren't going to help us, in my opinion. Even when rules are enforced, it's a small fine, and they resume cheating and stealing immediately. Remember when Kenny was caught marking millions of short orders as longs? He got a $7 million fine. What did his victims get? Jack shit. Try to remember, this is a guy that bought a $100 million painting during the pandemic and is in the process of building the world's first billion-dollar house. So ask yourself these questions. Did anyone get fired? Did anyone lose their license? Did anyone get indicted? Of course not. Guys, believe me, I hope all the new rules cause a short squeeze, but I'm going to have to see it before I'll believe it. Have you ever noticed Citadel headlines are always like a puzzle? They always spin bad news into good news somehow. In your upper right-hand corner is the video of Kenny shooting himself in the foot that got 1.2 million views, where he actually said markets are efficient because of active managers setting the prices of securities, trying to drive the value of companies towards what we think they should be valued. Now, of course, this sent the apes into a frenzy, but I disagree about one aspect. This doesn't absolve Adam or our board of all their recent missteps, nor for sitting on their hands while people like Kenny wiped out 90% of our market cap. And here are the headlines. Citadel is handing back about $7 billion in profits to clients. Ken Griffin's hedge fund firm performed better than peers in 2023 with a nearly 15% return for its flagship fund. Okay, guys, let me tell you the real headline. Citadel clients redeemed $7 billion of their money. Okay? They took money out during a liquidity crisis. Here's another one. Citadel sees departure of 4 portfolio managers. You know, when you do 15% returns, why are your people leaving? And here, this one is the most bullshit third quarter report I've ever heard. Citadel Securities revenue jumps to $1.8 billion on volatility. Third quarter exceeds $1 billion for the 15th consecutive time. New revenue figures disclosed as part of a loan transaction. New revenue figures disclosed as part of a loan transaction. What does that mean? Does that mean we're counting the loan as revenue? All right. Citadel Securities' third quarter revenue rose by more than 8% as the privately held market-making firm seeks to grab more of Wall Street's trading business. So you see, we're borrowing this money so we can expand. Okay? It's always a lie. It's always being spun. The firm run by Chief Executive Officer Peng Zhao generated $1.8 billion in the period, up from 1.66 billion a year earlier, according to people with knowledge of the matter. Not their investor relations department or whatever you want to call it. No, it's just people that are familiar with the matter. The figure has exceeded 1 billion for 15 straight quarters. Well, if that includes money that you borrow, then that's a lot easier, right? Asking not to be identified, the people said, disclosing private information. Okay, it's a secret? It's a hedge fund. Okay, it's not the CIA. Anyway, interest rate hikes, recession fears, and Russia's invasion of Ukraine generated trading windfalls in 2022 and then started to subside. But last quarter saw a return of dramatic market swings as the Fed Reserve's push to quell inflation with higher interest rates spurred demand for trading services. The biggest 5 U.S. banks pulled in more than $26 billion in trading revenue during the third quarter, up 1.3% from a year earlier. JP Morgan Chase took in the most at $6.6 billion. Founded by billionaire Ken Griffin, Citadel matches buyers and sellers in the equity and fixed income markets. It generated about $7.5 billion in revenue last year, using algorithms to capture and profit from tiny differences in pricing. Yeah, we know all about it. The firm serves asset managers, banks, broker-dealers, hedge funds, government agencies, and public pension programs. A representative from Miami-based Citadel declined to comment on its recent performance. The new figures were disclosed as part of an ongoing loan transaction the company is in the process of selling to debt investors. Okay. The firm brought in about $940 million of earnings before interest, taxes, depreciation, and amortization during the third quarter, a 20% increase from a year earlier. Following the loan transaction, see, this whole thing is about a loan transaction. The company's total cash on the balance sheet will stand at roughly $3.9 billion, with total debt at around $3.9 billion. Do you expect me to believe that these guys have $3.9 billion in cash and exactly $3.9 billion in debt? Okay. Citadel Securities launched a $400 million loan on Monday, with proceeds to be used for general corporate purposes, including trading capital, Bloomberg reported. The new debt, which holds the lowest rung of investment-grade ratings, will be added to the company's existing $3.54 billion term loan. So we needed $400 million more, and we basically got a subprime loan to get it. Bank of America, an AMC short seller, is leading the transaction, and institutional investors must decide if they will participate by Wednesday. Well, that's great. That's a really clear third quarter report, isn't it? And guys, just for the record, I'd like to show you the reported top short sellers of AMC. I say it that way because who knows if they're fully reporting, misreporting, what they've got going on overseas, but I've got to work with what's available. At the top of the list, Susquehanna. This is according to the 13Fs filed in mid-November, right? So I'm sorting by reported value first. Susquehanna, EMG Holdings, that's Ellington, Pentwater Capital, Citadel Advisors, and yes, our own investment banker, Citigroup. And that was updated December 6th. So they've got 1,113,000 puts against us. Okay. Now, if you sort by number of shares, or in this example, contracts, Susquehanna still remains at the top. Then followed by Nuttree, Hap Trading, EMG, Pentwater, Citadel, and Citigroup. I would just like to point out that when you sort by reported value, Susquehanna's short is 5 times the size of Citadel's. Now, guys, I found something really interesting under the radar, and I think it could develop into a big thing for the company. Let's go back to October of 2022. Do you remember when Netflix dropped their film Glass Onion in AMC theaters from November 23rd to 29th? AMC moviegoers can enjoy Glass Onion, a Knives Out mystery, at more than 200 locations throughout the United States, right? And then in the New York Times, can movie theaters and Netflix coexist? Rian Johnson makes his case. The Glass Onion director explains why he sold the Knives Out franchise to a streamer and how he feels about its theatrical test. Quote, I want more. I hope everyone knows I'm working as hard as I can to push for theatrical releases, Rian Johnson said. Now stay with me on this. In case you don't remember, let me tell you what happened. It was a big success. From CNBC, Glass Onion could have made $200 million, but Netflix only let it play in theaters for a week. Netflix may have left tens of millions of dollars in ticket sales on the table after only releasing Rian Johnson's Glass Onion in theaters for 1 week. The sequel to Johnson's popular Knives Out opened in nearly 700 theaters, the largest release of any Netflix original film to date. Stay with me. So let's get this straight. Netflix drops a movie in the theaters. It's a huge success. They leave millions of dollars on the table because they only let it play for a week. And then they decide this. Netflix continues to avoid theater release for its original films, dismissing all the rumors about Netflix original films getting a wide release. An insider states that the studio doesn't have any immediate plans to change its strategy and is focusing on getting most of its original films an exclusive digital release. So guys, let me tell you what I think is going on. Wall Street is whispering in Netflix's ear over and over again. Theaters are dead. Streaming is the future. But here's the problem. They've been proven wrong. Now check out this news from Collider about Napoleon. Napoleon global box office charges to new levels. But listen to this part. Apple Studios took a chance and released Ridley Scott's Napoleon in theaters, and it's paying off with $170.8 million in global ticket sales. The film has been successful internationally, earning $117 million from over 12,800 screens in 64 overseas markets. But in this other article, I remembered they said the film is essentially a streaming release from Apple, with its theatrical run serving as advertising for its eventual release on Apple TV. Now guys, keep in mind, Apple's strategy is already working. Napoleon is a big hit. And then I saw this tonight. Apple picked Sony to release George Clooney, Brad Pitt, Scarlett Johansson, and Channing Tatum movies. Apple Original Films has selected Sony Pictures Entertainment to release a pair of star-studded movies in cinemas around the globe following their distribution partnership on Ridley Scott's Napoleon. On your screen are the most popular streaming services in the United States: Netflix, Amazon's Prime Video, Disney Plus, Hulu, HBO, Paramount Plus, Apple TV, and Peacock. It's a simple formula, guys, and it's already proven to work. Drop your big budget original films in the theaters first as advertising for your streaming audience in the future. If this strategy continues to work for Apple, how long before the other streaming giants will have to follow suit and follow the same path? If Apple's experiment with Napoleon is proven to be the best path to profitability, the others will have no choice but to drop their films in the theaters first. Guys, I'm not even going to say what I'm thinking out loud, but what American company has the most cash? Back in May, they were saying Apple has so much cash, it's becoming a problem. I'm going to let you think about it for yourself. Hey, I want to thank you for watching, and please remember to hit the like button after this slide if you enjoyed the presentation. Subscribe to the channel and set the alert so you're notified when I have new information to share. See you at the bell.